So if you're looking to buy an investment property or a property to live in, one of the really important factors is the ability to get finance in order to fund that purchase. And today we're here with Ben from Commonwealth Bank. G'day, Ben.
Hey, how you going?
Yeah, good. How are you?
Yeah, good.
That's good. So today we're going to have a chat about how you can fund your investment property purchase. But before we kick off, Ben, did you want to sort of introduce yourself? What exactly do you
Yeah,
do
sure.
with Commonwealth Bank?
So I'm a mobile lending executive. So in a nutshell, we drive out to our clients across WA and assist with all their home lending needs. So purchasing, refinancing, whatever it may be. That's primarily what my role is. I've been in the industry now, doing this role for about 10 years across different sort of organisations. So yeah, it's a good role, a challenging role, and yeah, so.
Yeah, nice one. I'm sure you've seen all the different challenges that people have with getting finance. And I know I've asked you a few questions in the past for some clients and always come to the party with lots of good answers. So I'm looking forward to speaking about finance today. But some of the clients that we work with, sometimes they're either coming to buy a first property and they're using cash as a deposit for a place, or maybe they're going to take equity out of an existing property to create that deposit for that new property. And one of the key factors of getting finance is serviceability. So Ben, did you want to tell me what is serviceability and why is it so important in getting your finance approved?
Serviceability is probably one of the biggest crucial parts of your application. It may be also called borrowing capacity as well. You might hear that sort of thrown around. The way it works, to sort of simplify it, is your income minus your outgoings, and what's left over is what you have available to service the new debt. We look at outgoings such as existing home loan repayments or rent if you're still renting. If you're buying owner occupied, obviously it doesn't count because that's not ongoing. Household expenditure. So this can be a bit of a sticking point. So a lot of first home buyers generally don't spend as much because they're living at home potentially with parents, etc. What can happen is you might only spend $3,000 to $4,000 a month on an average. So that's like your utilities, going out, fuel, all that sort of stuff. But all banks are legally required to use a benchmark. So it's always which one's higher. And that, look, it can be a sticking point, but unfortunately, APRA does govern that rule. Credit cards, we look at, a 3.8% sort of percentage of what the repayment would be. Even if you paid off every month and you've got a $20,000 limit, that could really impact that borrowing capacity. And then, personal loans, car loans as well. So it's very simple mathematically. It's income minus all that, what's left over. How can we use that money into service the loan going forward? What's one really good way to help with servicing, just sort of explain, is, be honest, car loans, personal loans, kill servicing. Any deal that I can't get to service is generally, if both applicants or at least one has a car loan, about $500 a fortnight. That tends to sting a bit. Credit cards, if you've got multiple, so you might have them for the points, which is fine, but just need to go and prepare that you may need to get rid of some or reduce limits as a credit condition. So yeah, that's sort of how that works in a nutshell. The more income you have, the better. Obviously, the less expenditure, the better. More so credit cards, personal loans is your biggest killer, to be honest.
Okay, yeah, really great tips there, Ben. So yeah, what I'm hearing is really just maximize that income and minimize the expenses so you have, nice healthy cash flow, just being able to prove that you can service that loan, pay the debt off. Fantastic. Okay, great. And what other tips would you recommend for people if they're putting an application and serviceability is looking good? Is there any other tips that you recommend for presenting a nice case to the bank to say, hey, give me some money? Like any other recommendations?
Yeah, job history is a big one. So just sort of be mindful. Certain industries, we understand they chop and change. For example, shutdown crews on mines, so they get a bit more leeway. But if you're in a full-time job and it's changing every 3 to 4 months, that can bring down your application. A lot of credit checks as well. So if you've done, credit card, personal loan, then 3 or 4 home loan pre-approvals here and whatnot there, that's not also, that can also be a detriment. You know, we have about 5 to 7 a year. It doesn't really impact you too much. Repayment history is a big one. So a couple of years ago, APRA, which is the governing body for all our lending, brought out a comprehensive credit reporting, or CCR. What that does is every month there's like a graph, and it tells us how the customers are paying. 0 meaning they're on time, 0 to, it goes up to I think about 10 meaning you're in arrears. So that's a sliding scale. So, you know, pay your car loan, pay your personal loan, pay your credit card, pay your home loan on time every time, so that we don't fall into that arrears, or we don't have that missed payment, because that can really impact you as well. Big one with investment properties, just postcodes. A lot of banks have postcode restrictions around how much you can borrow too, and that's more economical. So generally, like your mining towns are a big one. So you probably remember the big crash when Craft at Port Hedland, say, 5-6 years ago when it dropped. So you only can generally go to about a 70% lend on those places. Adelaide Terrace, that strip of apartments, same rule applies there as well. So just knowing that can also be, might hold up your application. So just doing your research where you're buying and whatnot as well.
Okay, yeah. So it sounds like getting the right property in the right area can also make a big difference on the ability to get that funding. Yeah. Great.
Yeah.
Okay. You also mentioned there with the credit rating, and for some of us, we like to check our credit rating frequently to see what score we're sitting at. For others, they may have no idea what their credit rating is. Have any recommendations for the credit rating? Is there a way that people can check? How would you recommend they manage their credit?
So many apps now that you can go through. Like CBA's got one that we use. If you're a CommBank client, you just go on the app and register through Credit Simple. Credit Simple, Credit Score, Credit Simple. Those sort of ones are really good. It's really important. So Equifax are like the gatekeeper for everyone's credit files. Once a year, you're entitled to basically get a free credit report from them. That's a full comprehensive. It's got everything. Highly recommend doing that once a year. It's more so from a data breach application fraud. It happens a lot. As we've seen, we've had Medibank, Optus, another one came through the other day. Yeah, people got to apply for credit in your name, so that keeps on track of that as well. But yeah, apps like you go on searching, half of them are free. You want your score to be above about 650. So 650 to about, from memory, 650 to about 800 is like good. 800 and over is like perfect. Under 650 is not so good. So that's, and that comes down to credit checks, repayment history, how much debt you've got on your credit file. So if you've got a home loan, a credit card, and a personal loan, okay, that's okay. But if you've got 5 credit cards, 2 home loans, 2 personal loans, it starts to weigh in.
Right. Okay. So it sounds like it's really important to firstly be aware of your credit rating, but then also getting on top of the transactions that are going on there, and even getting some advice on how to maximize your chances of maximizing your score so that your case towards the bank looks a lot more positive.
Yeah.
Okay. And is there anything else that you recommend that people get, I guess, organized, or anything that they should have prepared when they're coming to a bank to request for funding for an investment property?
Yeah, come prepared and come with an open mind. So you may not be able to do it now. There may be 6 months down the track. It may be something you may go with the $500,000 budget, or we can maybe only do 400. So that's my biggest piece of advice, is going with an open mind. We'll work with the client. Like I always work with my clients to get them the outcome. But sometimes you can't, right? Sometimes it might not fit that box. You've got to try and look around it. Come prepared. Make sure you're bringing your pay slip. Do you get bonuses? Do you get overtime? Do you have loans? Bring in a statement so we can have a look at it. It just makes our life that bit easier, makes the application process smoother. If there is any issues that you think might be an issue, just tell us, because then better me knowing and going in ready to go to credit if I need to, rather than finding out midway through the application and it falls apart. Stuff like that. Savings, simpler the better. Income versus savings. If you earn 80 grand a year and you've got 20 grand in the bank and you're a couple, okay, that's fine. No problems, right? Because you look at what goes in, what goes out. But quite often we see a lot of clients on high disposable income. So I'm talking 200 plus. They have nothing in the bank at all. Single or married, or even without kids, and that's where we look at it and go, where's the money going then? So that's a big one. think of it very simple. Just break it down simple. You know, money goes in. If I'm making this much a year, how much roughly should I be having behind me?
Yeah, okay. So yeah, it sounds like if you're earning 120K, if you can't get the finance right now, just having a plan for 6 months down the track, you might
Yeah.
need to make a few little changes to your spending, maybe reduce some expenses, make your books look polished so that you can maximize that chance of getting the funding. Okay, great. And typically for buying a property, most people require a 20% deposit with the bank
Yep.
covering the 80%. But tell us if people don't have that 20% deposit for a property, what other option, whether it's in equity or whether it's in cash,
Yep.
what other options might they have?
There's a lot of schemes and just different solutions out there. So I think a lot of us get caught up in this 20% rule, which is generally what happens. So there's two types. We've got obviously investor customers versus your owner occupied. So investment banks will lend up to 90% of the house with LMI, obviously. So you need about what we say 12% deposit because you got to allow for that lender's mortgage insurance component. Okay.
Yeah.
Now, lender's mortgage insurance is a bit of a dirty word, but I always say to my clients, if long term, over a 10 to 15 year, and it's going to generate you the revenue, save you say $7,000 a year in tax. You pay it once up front, part of your loan repayments done. So that's what you got to think about as well. So we go in thinking, oh, we don't want to pay LMI. We may then long term be better for you. So that's one aspect of it. Guarantor. So if you've got family members that have properties that are unencumbered or are very low debt and they're still working, the only rule with guarantor, they can't be just on a pension. So that's our biggest rule. We don't want someone that's about to retire on a pension going guarantor. They can use that 20% of their equity as a guarantor. I've had gifts or cash deposits from family as security deposit. That's perfectly fine as well. So there is a few different options there. In the owner-occupied space, we go up to that 95% inclusive of lender's mortgage insurance. So that's 8% deposit. Easier way to articulate it.
Yeah.
But there is a lot of schemes, as you know, the first home buyer guarantee scheme. So you only need 5% deposit, no LMI. That's for citizens. There's income caps, etc. Similar to a key start setup, but not as bad interest rate. So there's that as well. And then guarantor, equity is a big one. So if you've got equity in your current place, let's say your house is worth 400,000, you go up to 80% of your house what it's worth without LMI, take that money out, minus off debt you've currently got against it. Yeah. That's your equity. That's the usable equity you've got in your house.
Okay. Yeah, I've heard of family members and friends who have used guarantors before, and one of the common things they come up against is parents say, "Look, I don't want my house tied up in your loans."
Yep.
But from what I understand, say you were to have a parent or a family member use your house as a guarantor, after say 2-3 years, the property's gone in value by 10 to 15%, maybe 20%.
Yep.
You can actually get that reassessed and split that off so that there's no connection between that family member's house and your house.
And we split it out. So let's say you do 100% lend, just to make it simple to understand. So 80% of the loan we have as one figure, 20% as the other, and the guarantor's linked to that 20%, not the 80.
Right.
So that way it's trimmed down to only the percentage they need to be. It's not open-ended.
Okay.
Also, then you can control, so all your extra money and extra payments, you can focus on the 20% to then release off the guarantor.
Right. Okay. I didn't know that. So yeah, I guess less risk then for those.
Yeah, people. Less risk.
Yeah.
I had a client the other day. He used cash deposit. So he had sold a property to mum and dad, and they had acquired a substantial sum of money. We did a term deposit as security guarantor. So that was much better. We looked at it and he was like, look, I was just going to put it on my mortgage, so I might just do it this way. Then his house wasn't tied up. So It's all about us working with you and the clients to get the best solution for everybody. Like what's going to work. Yeah. Not just a quick fix and just go, oh, well, we can't do it this way. Let's look for a solution outside the box.
Yeah, look, that's really great because I think a lot of people get caught up, as you said at the start, I have to have 20% deposit. And if I don't, go against the property market. But if you're in that position where you don't have 20% deposit, then it's worth making inquiries because there might be a solution out there for you. So good to know. Awesome.
With their lender's mortgage insurance, one thing I've had across the years, and this is very specific to some banks, and most lenders do this. So let's say with NAB, Commonwealth, or ANZ, one of the majors, you paid lender's mortgage insurance with them up to a certain 90 or 89% threshold. If you go back with that original bank and you cash out your equity, you don't have to pay the full lender's mortgage insurance, generally speaking. Again, you only pay the pro rata because you've already basically paid it up to, say, 80 or 89 or 90%. You then take it back out, say 10 years later, you just pay the difference, or like a pro rata. So it's really important to ask if that's something that, so I can tell you now, CBA definitely does that, and NAB does it as well, because I've worked for both. It's all about asking the questions.
Right.
That way, you might only be up for $1,000 or $2,000 extra LMI, but you can cash out $100,000. So, yeah.
Okay. Awesome. And one of the comments I hear from experts in the property field is when you're getting finance, don't cross-collateralize. I hope I
Try and avoid it.
Yeah, it's a big word.
Yep.
Tell me, what is cross-collateralisation, and is it a good thing? Is it a bad thing?
Look, like anything, it's got pros and cons, like a fixed and variable. So sometimes the bank will say as a credit condition, you must cross-collateralise or cross-securitize. Nothing we can really do there. That's what it is. But if you've got the choice, try and avoid it if you can. So think of it like a Jenga puzzle, that everything's linked and stacked into each other. So if you have your owner-occupied house and you want to use that equity or cash security there for your new investment purchase, and the bank secures the new loan against property you live in, so your owner-occupied, and the new property. What can happen is if the second property that you've just bought, you want to sell that in 5 years' time, if that value suddenly reduces, which I've seen happen over the years, the bank will say, when you want to sell that, we want to take all the sale proceeds to reduce the debt at 80% or lower on the other one. And that's where it can get a bit tricky because the banks have their certain rules. So if you separate them out, you cash out your loan here, so you do a 80% lend on your owner occupied, that money just comes out, we just put it in the bank, it's ready to go to deposit. Loan number 2, 80% of your current property here. You can still do your 100% lend because you can use that as like a sort of cash security so you get your tax benefit, that's fine. But it stops that when it's being sold, you basically would take all the proceeds and divvy it out as you see fit after the debt's gone. So it gives you the control back in your pocket. Some lenders, and not as the person, but the bank may say, no, you have to cross-securitize, and that's okay, but just understand the risks. If you can get away with it, don't. Makes your life that a little bit easier.
Yeah, really good point. So I think it's really important that when people embark on their investment journey to ask the right questions, because sometimes you might be put into a situation and you actually don't know what the outcomes could be. So speak to your bank, speak to your lender, get all information around that. You need to have
two big questions is why are you doing it? As you probably discussed this with your clients, like why do you want to buy this investment property? If it's for a retirement plan, is it for tax purposes? Because that really drives how we're going to structure the loan, and also even like how you're going to structure the purchase. So if you, for like negative gearing benefits, it's always better to have the predominant earner own the property or more of a percentage of the second, or than the less predominant earner. So if you've got husband and wife's at home with the kids, husband earns $200,000 a year, it's almost better just being in his name, or 99% to 1%, because you're going to end up, it's like you want it lopsided because he needs a tax benefit, not so much wife. So really getting that sound tax advice before you sign on the dotted line as well.
So speak to an accountant, get the professional advice. Really important, absolutely. And at the moment, I mean, we all know it, we're in a rising interest rate kind of situation at the moment. People are a little bit nervous. There's a little bit more confidence returning, which is really great. But this is probably, it is the highest sequential rise in interest rates that we've seen in this
I think ever.
Ever. Great. And the rates have gone from 0.1 to 3.1%. And we'll find out next week what happens for the month of February. We had a bit of a break over the holidays, which I think people probably enjoyed. But Ben, did you want to tell us? So, one of the misconceptions I think is even though the rates have gone from 0.1 to 3.1%, like that's technically triple, right? As the
Yeah.
official tax rate. But do you want to tell us, like, is that true? Have the repayments gone up significantly? Like, is it as scary as what it sounds?
Look, it has for some people, and you got to remember everyone's situation is different. And to give you probably a little bit of context, during COVID, we were doing home loans at 1.74 fixed for 4 years.
Wow.
Now, a
Yeah.
lot of those clients start dropping off in April onwards. So if you go onto Google, any website, type in fixed rate cliff, you'll see all from $480 billion worth of debt will start rolling off fixed. So those clients will start moving from 1.74 up to your high fours, early fives. So I
Mm.
think once that happens, to be honest, we'll see that inflation figure come down. Because if you're on 1.74, you're probably not adjusting your spending relatively to someone who's on 4.87. So I
Mhm.
think I think once we see in the next couple of months, these clients start getting their letters, notifications, they'll start dropping off. That will help as well. But it doesn't triple your repayments. If you get to $1 million, it probably does.
Yeah.
But for example, so on the Commonwealth Bank website, go into the say repayment calculator, and there's a little button down the bottom right that says, "What if the interest rates change?" So on a $400,000 mortgage, which is probably about your average loan size, give or take in WA, every 0.25 it goes up, it's cost you an extra $60 a month.
Right. Yep.
It's 60 to 100. So this is why it's really important when we talk to customers, understanding that we're in a rising rate cycle. Different 2-3 years ago, rates were low, it wasn't as much of an issue, but what goes down must come up. I'm sort of working out with my clients, let's say rates hit mid fives to sixes, is it still affordable? And they go, yep, end of the day, I can give you the money, but you got to pay it back, not me. So
Yeah.
and it's not about like that forever. It's not going to be high forever. It will come, crashing back down per se. But that's where it's really, really important. Is fixed more important to you? Is variable more important to you? For me, I might write out the wave and go variable. But for a couple with 4 kids, you might want to fix it for a year or two. Just that's what your preference is. So yeah, it definitely doesn't triple, but you will feel the pinch when it goes up. The bigger the debt, the worse it is. I think the problem we've had is just for the last 12 months, it's just been one after the other, after the other. And we've not seen that. So you're going to get that rate shock and that real sort of knee-jerk reaction.
Yeah. I think given that, I mean, we're saying that the interest rates are really high at the moment, aren't we? But if we look at historical times, the interest rates are still very low compared to what we've seen over the last 30 years. I remember when I bought my first investment property about 12 years ago, the interest rate was about 8.5%.
Yeah, 8.5. That's when I first started lending. I remember that. Yeah, 8.5 for an investor and 6.5 for owner occ.
Yeah. So depending on one's situation, it still can be very affordable. We just kind of got fairly comfortable with those ultra low rates. And it's just sorry, go ahead.
Just remember as rates go up, your affordability does come down.
Right.
So it's really important to make sure you've got your pre-approval. Ask the bank, does this cover me for the next 3 months? So we offer a service where the client confirm their pre-approval as long as all the documents are provided. So they've sort of covered for the first 90 days of their pre-approval before you're going to reassess it. So every time the rates go up, that's going to kill your borrowing capacity a little bit more. The reason being, we're all banks, not just CBA, so your ANZ, your Westpac, your Pepper, whoever it is, it's the actual interest rate the customers charge plus 3% is applied. So we do have buffers built in when you apply. So if rates did go up, we sort of know, yeah, you can still afford it.
Yeah, really. Yeah, I mean, we've got one of the most robust banking systems in the world. And I think all those buffers and the checks and balances in place are there for good reason. Yeah. And it means that we should see that over the next 6 months with those rate increases, I guess the housing should remain fairly stable given that a lot of those checks and balances are already put in place. So, great.
Yeah, after the GFC, we learned a lot. So a lot of things. And even after the Royal Commission, as much as, in our sector, it was a bit of a shake-up, it was needed and it helped a lot of these robust and these measures in place. We're not lending money to people that can't afford it. Yeah.
Well, Ben, this has been awesome. I've learned so much today, and I'm sure that our our watchers have as well. And if there's any questions that you have that have come out from the conversation today, you're welcome to pop them into the chat below, into the comments, and we're happy to answer any questions you have. And also feel free, if you're looking to buy an investment property or get into the property market, feel free to reach out to myself. Always willing to chat about property and what strategy you want to take. And of course, people can also reach out to you, Ben. Ben, do you want to tell us how can they reach out to you if they've got any further questions about finance?
Yeah, sure. So I am based in WA. So even if you are over east, that's fine. We can do it remotely via, say, Teams, Zoom, by the phone. Just watch the time difference. That's really hard to catch. But yeah, I'm happy to come out to you if you're in WA. I don't really have an area. I'm happy to go anywhere. Phone number 0476 897 628. Leave a message, text message is fine. Email is ben.o'keefe@cba.com.au. So I'm on LinkedIn as well. Even if you reach out to me on that platform, happy to just have a chat. Even if you want to have a chat over a coffee and just have a yarn, no problem at all. You know, like, it doesn't have to be you want to buy something, just, always here to have a chat.
Awesome, Ben. Thanks so much. Thanks for watching today. And any questions you have, Ben is a wealth of knowledge when it comes to finance. And thanks for watching. All the best.
Thank you.